Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 28 of the New Barbarians podcast. Today is Wednesday, July 16th, 2025. The podcast will hit the platforms later today. Today we are joined by Jennifer Murphy, founder and CEO at Runa Digital Assets. I will probably chime in a little bit with quant performance, but yeah, the market looks pretty flat today. So not much to talk about on my end, and I'll pass it off to Mark.
Yeah, Bill, that'd be great because we're going to talk about some sectors and in the TradFi world and what it looks like in digital. And I'd like to get your feedback on what you see on style factors. I'm hearing some macro funds had a tough last 6 to 8 weeks, and that there was some rotation. So love to have you dive in on that. Yeah, so Jennifer, we're way excited to have you here. So thank you. As we mentioned in the green room there, we're going to go over some slides here. And since I realized that we need to use Chrome for Riverside, I now know how to share my screen, Bill. So you don't have to rummage through my your inbox as we're recording here. So the big boy pants are on. And this is our classic, Jennifer, every time we just have a scorecard. I've noticed that sometimes people just want to know what's up, what's down. We can talk about vols and other abstractions to make our point and feel very intelligent. But I like to look at what's happened recently and has it persisted. So the scorecard on a 1 year and a 5 year compounded annual growth rate shows that Bitcoin and gold, kind of the leaders, for the most part, particularly Bitcoin. And you'll see a drop off when you get to NASDAQ, S&P, and obviously the laggard here in the dollar down as much as 10%, I think on June 30th. So there's some separation here. It's not everything up rally like we had in 24. Bitcoin kind of, as they say, breaks the ruler here by being up 4 times more plus than any other major asset class on a 5-year rolling basis. I'm not going to spend much more time here. That's the lay of the land. Now let's go into the equity world, which brings into focus folks like NVIDIA and a topic I'd love to touch on, Jennifer, which is, and Bill, because I know you're involved in the space too, Bitcoin treasury companies, which may be this year's cycle phenomena. Every cycle, people want to know who's going to lead the charge. And MicroStrategy compounding 100% over the last 5 years, unbelievable in the S&P 500 from a forgotten hula hoop, basically, of an intelligence business prior to jumping on the Bitcoin train in 2020. And what we want to talk about here too, again, back to Jennifer, I'm going to tee you up again with a few things. The separation. We're looking at the Mag 7 where, 3 of them are down. Amazon's almost flat. And it's only the AI focused folks. So even though we're talking a lot, what Bill's doing on the AI side, if you haven't read his research, you are missing out. You are overpaying. You're underutilizing what's going on. And folks like Meta, Microsoft, NVIDIA obviously are not missing out. That's the reason they're up. And then again, look at the 5-year, MicroStrategy, NVIDIA, and Bitcoin. So digital assets and AI, Jennifer, that's why you're here. We're going to talk about that more. And this is for the folks who are naysayers about Bitcoin's volatility. A lot of us are worried about it actually being too low. The trend is declining. Does Bitcoin have enough juice to keep rolling? I think it does. But NASDAQ's volatility is increasing. Bitcoin's going lower. No equity strategist on Wall Street has ever figured out how to answer the question if that's good or bad. And I don't know if if you guys, Bill or Jennifer, have ever come across someone who said, oh, this makes sense and it doesn't matter, Bitcoin's volatility is still too high. I mean, have you guys run into anyone who's...
Yeah, I think for those who believe or that Bitcoin should act like a currency, they think they're always complaining about Bitcoin's volatility being too high. I think as investors, that volatility presents an enormous opportunities. I think investors like it. I think Michael Saylor at MicroStrategy, he's finding ways to kind of parse out the Bitcoin's characteristics, including its volatility, and sell that to just the investors who want it, which is fascinating.
It is. He's done it. It's almost like that Walt Disney movie Flubber, where they took that stuff and put it under the sneakers, and then like Michael Saylor's taken his Flubber, shoved it into an equity wrapper, and it's bouncing around Wall Street, just making money for everybody.
So I don't know if everyone saw Flubber. I can't really speak to that, but what I will say is, as I've assuming everyone's listened to me for all these months, I've said it many times. I was very late to the game with Bitcoin in particular. Mark was the one that talked me into it. And I bought the ETFs when they came out because I was like, oh, I understand stocks and but the real thing was Mark showed me the graphs that show, persistently going up every year. And like the rolling 5 CAGR, or I think that was probably the one where I was like, oh wow, this has been a while. And being trained as a classic quant risk manager, I just hated volatility, hated it. And that's how we measure everything. It's like even our like risk features that we put into models are all based on volatility. So, standard deviation and all that kind of stuff is always calculated, correlation, covariance, blah, blah, blah. But like I looked at the chart and I was like, oh, so you can just keep making money. That's cool. And then, now that you kind of articulated it, Jennifer, it's also, looking at skew and some things that I think are classic TradFi measures. And so, if you're in the options space, like they've been attracted to this for a while longer than some of my other friends. And like eventually, like lots of my friends are like asking more now. And so, some of that's actually with like the regulatory environment and things getting a lot better for crypto assets, obviously. But, high level, a TradFi quant was just scared by the wrong thing for too long. But it's not too late. That's the good news. And that's all I'll say about that.
No, thanks, Bill. And I love when you were, talking about how you looked at it, and I need to see things. Too much stuff going on in our heads. We're all audio, and you need to see it. And when you saw that positive skew, most volatilities are negatively skewed. That's why you and every quant should be concerned about vol, because it doesn't turn your frown upside down. Let's say it's always a surprise to the downside, and that's not the case. So let's keep ripping through some slides, and we want to hear more from Jennifer. So the reason why Jerome Powell is going to leave, and the reason why maybe Scott Bessem's going to step in, bizarro news out there, or at least as I was speaking to the folks ahead of the call, the most haltingly uncomfortable conversation with Scott Bessent with the folks at Bloomberg yesterday or the day before, where he demurred very unconvincingly about his potential nomination as the next Fed chair. So all that kabuki theater aside, the reason I'm going to show this graph and the next one is we haven't been here in a while at 4.5%. And we've already refinanced over $10 billion of treasuries this year because they're all short-term, 1 month to 1 year. And they're refinancing at higher rates. They're all going from like Jennifer, like a 3.2% coupon up to now 4. And every month that clips, we're rolling it into, all the bills are already up here, but we're rolling the coupons into the higher bill rate because people will only want our bills as collateral. They don't want the UK 30 years, which are rising. They don't want the Japanese 30 years as growth slows and wages go up. They're a mess. Their 30 years are going to like all-time highs. So look at this. Interest rates are at a very unique position relative to last time was 2007. In 2007, our debt to GDP, I know I flashed a new grid at you, was only 60%. The last time we had this type of interest expense, we had less than half of the debt to GDP. We are encumbered and we can't afford a 4.5%. That's why rates are going to go lower. And that's also why I believe people are looking at something like gold. They're looking at Bitcoin. They're looking at assets that won't debase when we continue to blow through the debt ceiling like we did in, I think, 8 hours, maybe 4 hours, Bill, when we spoke earlier this week. We went up $389 billion the minute the debt ceiling broke. So,
which, you know, my immediate reaction also was, well, did that actually happen? Or was that a artifact of bad data?
no, it did happen. It's
But it
sustained
happened
for the
a while ago, right? Like
July 7th.
But
I see what you're saying. I see what you're saying.
The debt was incurred,
Well,
presumably, or maybe they borrowed.
Yes. So you're saying, I said no to you a few days ago, but you're right. Because what happens is now the Treasury won't put off all the payments to the pension funds it has, like it started to do in 2023 in the last debt ceiling. They just stopped paying the pension and they give IOUs. And then now when the debt ceiling's gone, Bill, they say, okay, I'll backfill the IOUs with debt now. So yes, it was spent. They just have to, it's all just ridiculously silly.
It's accounting.
If you want to follow the money, right? I mean, we've seen it, we've heard it. Back to Nixon. So market cap breakdown. I like this. And Jennifer, when I was at 3IQ, I was new to the space, head of research, came in March of 22, ready to get my teeth kicked in with the rate rises, with Terra Luna. So I really had to re-underwrite everything and convince myself that I was in the right seat in the right space. And this kind of chart, I thought, really helped me speak to clients and start the conversation. So when you see this, is this help you with your clients, or are you talking to more institutions that don't need the kind of tiering to start, like the entry point?
Well, I think the one of the things that is the characteristics of crypto are this strong network effects in crypto. And I think you're seeing that also in equity markets, right? With the Magnificent Seven, I think those businesses have, I think, strong network effects as well. So the more they succeed, the more they succeed kind of thing, the more successful they are. And there's some very strong aspect of that in crypto as well. So one of the things Max and I, my partner Max Williams and I have been talking about is the altcoin, this expectation that we'll have an altcoin market. And the world hasn't promised us altcoins, right? It's not something we are entitled to as digital asset investors. And Max was posing to me, like, aren't the Bitcoin and other treasury companies really today's altcoin, this cycle's altcoin market? Aren't they really what's attracting capital and, what's really driving this cycle? So we talked about that at length this morning. I think there's a lot to recommend that. So I think we're sort of thinking with Ethereum going up is really the best hope for other tokens, because I think managers, when Ethereum rises, sort of everyone, institutions and retail, get more interested and start to cascade, to the ecosystem and then beyond that to other tokens. So I think that it's important to be invested beyond a Bitcoin and the majors, but nothing's promised new all-time highs in Ethereum just because we've gotten them in Bitcoin, for example.
But that's why people come to you and other players, professionals, especially with your background, is because they can get Bitcoin and ETF, they can get it. But how can they get that diversified extreme? When you look at the world, I just showed a very simple graph. It's a red, yellow, green almost. It's a total. It's Bitcoin. It's altcoins and it's everything else.
Yeah.
How do you calibrate the world. We look at 11 sectors in the equity world. We talked about, financials versus tech. People like to look at a basis. What's your next cut when you talk with clients besides that simple one I showed?
We talk about the sector analysis that you just described. We use that too. So we have 5 simple sectors plus stablecoin as a 6th sector, and that's what we invest in. And so those sectors are things like currencies like Bitcoin, protocols like Ethereum, and decentralized finance tokens like Uniswap and things like that, et cetera. Gaming and metaverse stocks, entertainment, and utilities, all those things. So our goal, Max and I both, we run 2 portfolios, and our goal is to be diversified across those sectors. Sometimes that's hard because it's not unusual in each cycle for one of those sectors to dominate. Protocols have dominated in the past. This sector really seems like decentralized finance. It's all about the decentralized finance. It's about finance in general, right? Mark, you were saying that before when we were talking earlier today. It's all about about the marriage of crypto or the invasion of crypto
Yeah.
into the banking business. So that's dominated our portfolios, and we've really struggled to find investments in other sectors other than Bitcoin. Bitcoin has been in our first portfolio has been a mainstay because we think we're still in that adoption curve, adoption cycle. We're just crossing the chasm now. I think we have crossed the chasm. I think Bitcoin is mainstream now, but it's early mainstream. So there's still a long way to go, and the total addressable market is so large.
Okay, say it. Come on, let's put a number on it, Jennifer.
100 trillion, or I don't know. It's
that's
the markets. Yeah. So it's big.
I agree. I'm going to show one more slide, and then we're going to back up into your story. Exactly. I want to know how in the world you got here from where you started. So this is when we talk to the reason I bring this up and we talk about TradFi and stocks and digital assets, most of the folks who come here are this is their first entry. They're getting into it. We do have some digital native, but we have folks who are gig workers or analysts saying, what should I do? So when you see this is your decentralized finance. This is coin. Why is XRP above where's Solana Summer these days?
Yeah, exactly. That's right. Yeah, actually, and for the first time ever, we bought equities in our portfolio, which we have not done. In the April tariff tantrum, we bought Coinbase at about just under $150, 146, and just sold it actually because it's really I think realized a lot of the undervaluation is now gone with it at, I don't know where it is today, almost $400.
Yeah,
that was a good trade. But also we bought some miners. We bought a mining stock as well in that tariff tantrum just to get that upside. This equitization of crypto is a really, really strong trend.
Yep.
We're not the only crypto manager that's extending out to equities as a result.
Yeah, it's your point about the activity. It's obviously from M&A, which there's some activity in the space for the first time, some very large deals. I think one of the largest was Coinbase and the Dubai-based derivatives firm Durbit.
And also, I don't know how related it would be, but the Ninja Trader $1 billion acquisition by Kraken was perhaps a foray from a crypto native business into TradFi as well. And I think that when you do that type of an acquisition, you also get access to the futures merchants and whatever else, like the regulatory stuff that you need to look at.
I think the biggest point Jennifer just brought up is that you're buying equities. When we look at the total addressable market, it's three odd trillion. We just saw it in digital. It's 150 trillion equities. It's 300 trillion of bonds. It's 600 trillion of financial assets or more. You look at Grayscale saying, why are they doing an IPO? Why doesn't someone buy them? They want to issue equities and buy digital assets. They want to be a BTC-TC.
Yeah.
So what do you, Jennifer, all right, I'm going to hold off on that question.
And let me jump in for 1 second. So the live stream is having issues. It says we have a poor connection, and I can see it's kind of going in and out. Just FYI, like this will be available on the platforms and we'll edit it and it will be fine. We did get a question that I will ask in a moment, but since Mark shared his screen, I'm going to quickly circle back on the quant stuff. Hopefully this comes up. So yeah, like in the quant factor space, I don't think any of these moves are statistically significant, but yeah, like tariffs.
Obviously, there's a non-Trump supporter in the room here.
Buster, he sees people or dogs in particular, and I'll try and mute him. Anyway, so there wasn't a lot in the factor space, and Mark asked about macro, and like the word on the street from this is offline conversations are that some of the macro quants are being jettisoned or shut down. So at the multi-manager, multi-strat hedge funds, basically you have an agreement that if you persistently lose money for a certain period of time, they blow you up. And so, reading between the lines, I think that some quant macro strategies have not done a good job of forecasting tariffs and everything that's happened. And so that kind of gets back to that tariff tantrum. Thank you for the phrase, Jennifer. It's always important to have those types of phrases coined. I mean, I'm being serious because then you remember them and years later you're like, oh yeah, that's when, Bitcoin went to, what was it, 70 or something? Like, congratulations on your recent really good trade, which there again, I got freaked out and, I was, complaining to Mark and doing my usual like non-quant thing, getting emotional. And then I just thought I'd also share the latest from, I think, yeah. So this is, Wolf put out a note about Bitcoin, a record high of 123. And then it's interesting. Yeah. And then I guess basically what I just talked about. And you can see some of these moves are big, but I doubt that they're statistically significant. And then in the factor space, size, so I think that's just Bitcoin and Ethereum. Liquidity and low vol have done well, while momentum is not. And perhaps that is like the altcoins. I'm not sure, but that's where it's kind of fun to dig in after you finally look and share it on a live podcast. More to come in the research space from Mark's Substack in particular.
Yeah, I think momentum is often where crypto altcoins have shined, and many crypto managers favor momentum strategies because they've done well. They've done well in the past. I think it's interesting this year, as seems in crypto markets, maybe in all markets, Mark, you would know better than me, macro has dominated so much, and then this equity, which maybe it's related, but the equitization of crypto, it's meant the people who are focused on macro and equities as in their backgrounds or in their approach to crypto investing, I think have had an advantage. Whereas in previous years, there was a real advantage for the people who had tremendous tech and crypto technical chops who could look through all these new projects and really pick out the big winners. That hasn't been as much of a factor this year at all.
No.
I also forgot the kind of punchline with the shutting down some of the quant strategies at the multi-manager, multi-strats also meant that the discretionary macro traders were doing a lot better. They can digest the news and put trades on that monetize, their ideas, and quants can't, because from a systematic perspective, you'd have to go back to the last tariffs and hope that the world behaves the same way. And then your model actually has to allow you to do that. And pivoting strategy based on, macro news, it takes a while at the least. And then, when you said some places they like the the momentum trade, like so do I, but I need the crystal ball that gives me the reversal factor and I know when to get out. And then, so just to make sure we do ask our question from the live chat, which again, apologies, I can see we're flickering in and out. What's the best way to raise capital? And, this might be a good one for you, Jennifer.
The best way to raise capital in crypto markets, Bill? Is
that was my follow-up question. So yeah, like maybe start there, and then given what I've been up to, I can opine a little bit as well.
The best way to raise capital is to fit in a bucket. So that's why I think venture funds have been very successful. Private equity was so successful. Now private credit is there's now we buckets created for private credit. So now
be careful.
Money's rushing in. Yeah, I'm sure Mark saw Jamie Dimon was saying, I think today, that we may have seen the peak in private credit already, which was interesting. So I think, Bill, to that viewer's question, one of the things that we've struggled with and that people have struggled with for time immemorial is not yet having a bucket for many institutions or individual investors having a bucket for crypto. When I worked at Legg Mason, I worked with the legendary small cap investor Chuck Royce, and he told me when he started his firm in the 70s, there was no such thing as small cap. There was no such category, and it wasn't until MSCI created an index for small cap that it became a bucket and it became sort of an allocated asset. So that's my maybe glib answer to the question of how do you raise assets?
No, I think it's spot on. When there's capital, especially like driven to an asset, like with an index, like that's actually a quant trading strategy, flows into and out of indices. And then, I'll just add to that, like in the VC space, with fintech companies, it's really hard, and you basically need to know people. A lot of it's networking, like literally like running into someone, and talking to them about what you're up to. Like just recently, I had a friend, I literally ran into each other and I was like, I'm interested in capital raising. And he was like, I need to raise capital. And so, we even just like talk shop a little bit. And, I think I'll introduce him to someone now and vice versa. Like I think even recently talking to people like potential guests on this podcast, you run into ideas and things. That's a long-winded way of saying I think that you probably need to keep at it. You have to be okay with people saying no, and you have to spin everything into a positive. So if someone didn't give you money, it's because they were the wrong investor for you. You're the right thing. You just have to, retool your deck, go back to the drawing board and, pound the pavement. Don't give up. And, it's okay to have people say no to you every once in a while.
Yeah, Bill, I think you're right that the alternative, especially if you don't fit in a bucket, is to use your network and the people that they introduce you to. So the secondary network beyond your network, that is the best source of capital, especially for things that are new. I saw on another podcast, the CEO of Clear, the service used at the airport, was interviewed, and she said that she went to early when she bought the assets of Clear out of bankruptcy. She went to Silicon Valley twice. She went trying to raise capital, in two periods with 3 years apart, and met with everyone and was turned down by every venture capital firm. And of course, it's now a publicly traded company. It's a huge success story, and no success for her. Those people, I think she drew on her network, including my old boss, Bill Miller, was a foundational investor with her, and was part of the early team that helped her get going.
Well, Jennifer, you touched on Chuck Royce. You dropped 1970s in there, which is my favorite time for not just music and finance, but much more. Memories of my Stingray, unbound nights in the summer, not going home. It was nice to be a kid then. But we dove way into markets. I could, as Bill knows, he just, if he could reach through the screen, he would slap me. It's like, enough. Let's go back. We have Jennifer on. I'd like you to go and tell us a little bit about Runa, how you got there, and as you know, my favorite author that you like, a little bit about Miss Perez.
Yeah. I've spent virtually my whole career in asset management. When I started as a young pup, I was raised from a pup by Bill Miller, the legendary equity investor who hired me right out of college as a very junior analyst. And that changed my life. That was just an unbelievable education. One of the great things about Bill is he loves to teach everyone that he works with. So I learned so much at his, just watching him. And he really redefined value investing in a way that allowed value investors to value tech companies, which was that innovation, I think, really helped me when I thought about starting Runa Digital Assets. I think he really goes back to, I think, what today people would call first principles, though I hate people say that way too much. I don't like it. But he sort of goes back to basics all the time, like buy low and sell high, things like that. But, he would kept coming back to, look, we value them based on the present value of future cash flows. So that's how you should value tech companies too. So that sort of simple idea, he really made a lot of that. And also the idea of, is Amazon a bookseller or is it a platform to sell everything? And I think he very early came to the conclusion it's a platform. And that idea was not accepted for many, many years. So he's the one who sort of showed me how to think about long-term investing and investing in things that are new and poorly understood. And not surprisingly, he's also an early Bitcoin investor since 2013. So when I was working in asset management and we were using actually blockchain technologies because our operational teams were saying this, we could transform our infrastructure, which I was responsible for in our organizational structure as the chief operating officer, that we could use this to take out a lot of costs, which we needed to do because asset management is no longer a high growth business. It's a mature, get your costs out, consolidating business. So we were doing that, and at the same time, I'm reading the Bitcoin Standard and taking classes in Bitcoin. And I thought, this is the most important thing happening in financial services. And what am I doing? This is a new asset class, and I'm right here. And I couldn't believe the opportunity to get in on the ground floor of a new asset class. So I left my role to start Runa Digital Assets with my partner Max Williams, who was at NASDAQ at the time, and having the same thoughts. All his clients were Jump and Jane Street and people like that. So we started Runa Digital Assets to capitalize on what we thought was the most important thing happening in markets.
And how'd you meet Max?
Max is my nephew.
Got it. So that's how you got the generational thing. And one
Yep.
other question, I'm going to go back to your point about first principles being maybe an overused, underutilized, is a 0 to 1. So I used to hang out with consultants, management consultants. We want to be a 0 to 1. So that's aspirational, but what does it mean? But when you said Bill looked at Amazon as a platform and not a bookseller, that to me that's a non-linear jump. Is that how his brain works and that's why he's good, or is there a process that people can kind of follow that you think they can emulate?
Well, Mark, that saying that pessimists sound smart and optimists make money, I think that's Bill in a nutshell. He
Okay.
is very optimistic. He likes most people when he meets them, which I'm more like, you remember the Real Housewives of New Jersey when it first started? There's a character, she had the best line. She said, "Before I like you, I don't like you." And that's me. But
That's funny.
Bill likes everyone at first, and he generally is very optimistic. So he spends most of his time thinking about what might this be. I'm talking about Bill, like, I shouldn't be speaking so definitely about how he spends his time, but
Right.
I worked with him for 20 plus years. I know
Yeah.
him well. So I think that skill of not being afraid to be wrong and being willing to think about how big could this be, and then placing probabilities on it. So he would do probability weighted valuations and use that as a guide. And that's what I think, that probability of, could Amazon be this sort of global platform for everything started out as a small probability, but a really big number. And then that probability grew over time. So I think that's well accepted now. But Mark, I know you're with me in remembering the Amazon.bomb cover of Business Week. That's when Bill was backing up the truck and buying, at one point he owned 20% of Amazon in his fund.
That's more than Mr. and Mrs. Bezos did, I think, maybe.
Yeah, he's
Not
still,
the new Mr. and Mrs. Bezos,
yes, that's right. The parents, yes.
the
And
parents. Yeah.
that conviction requires, a lot of SEC disclosures, and you're basically have to declare that you're an acquirer. And yeah, 20%. I don't know if I've ever really heard of a single investor, a single fund owning that much of, unless you're in like private equity space and NA. So
Bill, you're so right. That is so frowned upon. There are so many frictions in firms, and I think that sort of gets at why we're seeing this equitization of crypto. I think firms are so strong in driving portfolio managers towards certain behaviors and away from other behaviors. So I think there's similar stories about T. Rowe Price. They're sort of outstanding growth investors and early investors in so many of today's biggest companies, that if they had simply held their initial positions in those companies, they would be bigger than all of T. Rowe Price and all of their funds combined. So, but they're not allowed to do that. So, and Bill was under a lot of pressure when he had that much. Amazon grew to that big position in the fund. It's those structural issues can be either accelerants or, depressants, depending on the situation.
Yeah, and it goes to the only pick a few eggs and put them in your basket and watch that basket, as you said, very well, and reassess your assumptions. And we won't touch on it now, but the diversification benefit that people talked about, I think people should revisit that versus what their actual costs are in life, and does an 8 or 9% return pay for your life or preserve your buying power over time. So Jennifer, back to you. On the Bill Miller, with him, you learned the investment side. He figured out the network versus the cash flow, or network and cash flow, not instead of, but a new way of looking at it. Can you please talk about, maybe bring Carlotta in now, or, because that to me is everything. People to read a book or sit back on a weekend and probably do what you and Bill did and just turn everything off and just try to think about something new.
Yeah, I think reading is essential. I know people in our generation, I think, do a lot of reading. I don't know. I think people, I shouldn't generalize, but I think many people prefer podcasts and other ways of learning, and those are good sources of information. But there's no substitute for reading, I don't think. So I think we do a lot of reading. We have a sort of book club in Runa Digital Assets to bring different ideas, to talk about. And one of them was Carlotta Perez. Max heard about the book and read it and thought it was so applicable, and it is. What she does is she analyzes history, and in a more of a qualitative way divides history since the Industrial Revolution into technological ages. And she studied with data the characteristics of those ages and tries to lay out some of the commonalities of them. But one commonality is they last about 50 or so years. And they're usually instigated by a new technology or two or three. It's almost never just one. So, for example, the gasoline engine, oil is a driver of a technological age. The information age, the personal computer and the microchip, those are drivers of the information age. Of course, the internet, etc. So she lays out these 5 ages, and what do you know, 2025, we're exactly at 50 years from the beginning of the information age, which is really Microsoft and Apple, being founded in the mid 70s. And that's she's saying we're showing all the characteristics of the end of one age and the beginning of another. And I agree. I think the artificial intelligence and crypto together are part of that new technological age. I think artificial intelligence is much bigger and more important and more dominant in reshaping everything. But I think crypto has a critical role to play. And all the things that we're experiencing right now, the turbulence, the corruption, the fraud, governments struggling with how to incorporate this into government regulations, that's all characteristic of every age. And so all these things that we think are maybe a little disturbing or off-putting about crypto and artificial intelligence are really part of its maturity. So I think now that governments are wading in, especially on crypto, I think we're going to get what she calls the golden age of a technological age for crypto, where it's incorporated into society. Institutions know how to incorporate it into their rules and their systems, and it begins to really become part of people's everyday lives. So I think we're right on the cusp of that. I'm not sure where we are with artificial intelligence, though. I think it's maybe earlier.
What's her background?
Carlotta Perez, she's an academic. She's a researcher, academic. And by the way, she does not believe crypto is part of a new technological age. Someone asked her directly, but she is, I think, artificial intelligence. I think she is maybe more persuaded on that one. But it's a really small book. I have it right here. It's a tiny little book, but it reads like a textbook. So it's kind of heavy sledding, but worth the trouble, I think, in thinking about. Because Mark, you were sort of brought up the 0 to 1. I think things characteristic of ages is as they go on, things change more incrementally, and then when you get to a new age, things change 0 to 1. Things change. They make phase changes, and that's, I think, what we're seeing right now, and why many traditional investors are very perplexed by by crypto, by artificial intelligence, and how to incorporate that in what they're doing.
So I didn't get to chime in. My son was getting off the bus when you guys talked about 0 to 1. A lot of corp dev types of people and people that used to work at fancy consulting firms say that kind of thing. But I will say the horse-drawn plow was one of the most disruptive, technological advancements at one point. And that certainly brought farmers from 0 to 1. And then you also said something else about reading is fundamental, but I'm not sure. I don't think that's exactly what you said, which reminds me of LeVar Burton would always say reading is fundamental on the Reading Rainbow, if anyone remembers that
We bring
show.
cultural memes back to life on this show too, Jennifer. We hear it's good for our viewers.
And that's all I have to add.
When I talk to people who are earlier in their careers and they ask me for advice or what would you do if you were me, and I sort of point out to them, I think the average person in America reads, I think, 4 books. But even when you talk to people, even that sounds like it might be high. I'm not sure, but it's certainly not. It's not a big number. Whereas most CEOs who are interviewed, most CEOs that you probably have met and know, read more like 50 books a year. I tend to average between 20 and 30 a year. And in any given year, that doesn't necessarily make a big difference. But if you compound that over 10 years, and I'm reading 250 books to 50 to the person I'm competing with.
Or Jennifer, 4. Yeah, I think 4 meaning period. That's kind of a birth to death thing. Unfortunately, that might be the case as well.
A candidate who is interested in an analyst position with us and asked them about what they were reading, and the last book they had to look back to the last book they read, which was in 2023.
So I also have another admission. I have not read this cover to cover. That is the name of our podcast, and this book was written, I think Mark probably knows, 1926 or
no, Bill,
thereabouts.
1925, 100 years ago.
Yeah, cool.
By a Spaniard like Miss Perez and the guy who helped Orange Pill, Bill Miller, in 2013 at the Allen Company, which Digital Gold highlights. Yeah. And Bill, this book, we got this title for our podcast. Bill picked it up because of Mike Milken, right, Bill, from the Nabisco and that disruptive period. He spoke a new language of EBITDA and LBOs. This book, I found out later, it's the same stuff that's happening now. If you look at the populism, if you look at the disruption, there was post-war, there was debt, there was a redefining, there was a disaffected middle class. Yeah, so that's the one that we first did. And then back to reading, we're like, wait a minute, this has happened, but like
Yes.
he lays
But
it out.
and I would also, just to plug it, highly recommend that anyone who is entering the Wall Street world should read that. When it's written by journalists, I think it's written in a easier to understand language. Like, I remember reading Barbarians at the Gate summer after sophomore year. I decided I wanted to go to undergraduate business school, and I was like, okay, I have to learn about Wall Street. And you read that, you read Liar's Poker and some of those other very well-known books, and you do learn quite a bit about the business.
That was one of the things Bill would tell young analysts if they're following the insurance industry. They need there are iconic books about the history of insurance and the insurance business that they need to read. Not only for their own education but for credibility when talking. You can be sure the CEOs of insurance companies have read those books. They have that context.
So what's your favorite book recently? Actually, let's stop back. Let's go back to good behavior. About what's your sort of go-to when you have time to reassess. How do you take in the market? Do you look at client incomings? How do you manage the business? And what do you suggest like good work behaviors are for people in this age of insufferably amount of information coming at you?
Yeah. Well, it is hard not to troll around a lot. X is a very rich environment for crypto information. I don't know if it's possible to invest in crypto without being on X, but I know a lot of people don't like it, and so that might be painful. But I think it is necessary. That's where a lot of news breaks and a lot of information is conveyed. So Max and I both spend a lot of time there by necessity. But there are also great research firms that are dedicated to crypto. News firms like Blockworks and The Block, and they have newsletters. They send out a lot of newsletters. CoinDesk, we write for CoinDesk. CoinDesk puts out a lot of great content.
Yep.
So certainly places like that. But Max and I start each morning at 9 a.m., which gives us a little time to look at markets and do some work before we meet. But we meet every day at 9 a.m. to talk about the day, what we're doing that day, and what we're seeing in markets and what we should do about it, if anything, or what we're monitoring. And then we have more periodic weekly discussions about the portfolio, reviewing it in more quantitative terms and qualitative terms. We have dashboards that we review every 2 weeks about market trends, trying to assess where are we in this bull and bear market cycle, and other things in the macro environment. So we have a sort of cadence of things that we do to kind of bring us back to earth, make sure we're touching the data that we agreed years ago is important for us to stay attached to. But Mark, I think like any creative enterprise, there also has to be time to roam around. Some of the best work that our previous analysts have done, and we just hired a new analyst, he's starting in a couple of weeks, but we've given them a lot of latitude to go look for, to go use crypto assets, play games, to read, to take classes, and to really follow their own interests to find opportunities for us. And that's been their biggest value adds. So we like to leave time for sort of, I don't know, what do you call that? Free range time,
Yes, yeah.
Because business.
And the one thing you said earlier, which I loved, was where are we? And I think, given your experience, you are, there's the word wisdom, I'm going to say it, and you know what to do with a piece of information maybe better than others, but you may not find it, and an analyst may be able to bring something up to reassess. And this is what in the credit world people used to do. The test was to an analyst, okay, tell me where, healthcare 5-year term loan is versus the subpaper is right now.
Yeah.
Where are we right now in the market? Yeah. Where's my market? Where's the rate market? So that when there's a news event, you know where you are, you expect a behavior. If it doesn't happen, you either have an opportunity or you have information. So that was number one on Wall Street, drilled into me since first going on the desk in '86 on the corporate bond desk at Solly, was have an opinion or go home. and it better be informed.
Well, that reminds me of a great recent example in one of the hottest tokens in crypto, which is Hyperliquid. Hype is the symbol. Hyperliquid is a perpetuals platform, and arguably decentralized. I don't know if there's some controversy about that. Decentralized, perps platform, and perps are this great innovation in crypto that are coming to TradFi now. But anyway, Hype had something bad happened on the platform. Someone exploited the platform, and the token went from 16 to 13 or so, and eventually to the high tens. And I don't know much about it, but Max and our analysts knew a lot about it. And so in talking to them as it was dropping and everyone was selling it, it sort of looked not that cheap as a perpetuals platform. But our analysts said, I think I'm reading, some people think that Hype's in the running to be the everything platform, that it may be in the running against firms like Coinbase to be an everything financial services platform, but decentralized, a crypto-based platform. And I hadn't heard that before. So that's what gave me the conviction and Max to add it to the fund, in which we did. And that was the big idea that I needed to attach to, not just its current business, but what might it be, as a platform business, what could it be worth? I think the token, we sold it in the, some weeks ago, but it's now trading at 47 or 48. In a short period of time, in a few months. So.
Yeah.
But that's an example, you're right, of because our analysts and Max are out and listening to different things and reading different things than I am. They're bringing in important ideas.
There's one person we spoke with. We talked about her before jumping on, and she's brought up the term of information asymmetry and how much there is in the digital asset space versus, and it's publicly available. It's just there's an asymmetry. People aren't digging for it, or they're not spending the time, or they're not putting that on chain versus the off chain information together to get the value add.
Yes, and it's like, I think this is like what the equity business was like in the 70s and the 80s, where you could have an information advantage. Bill used to send me out to the Midwest to visit Baldwin Piano and, companies like that no analyst had visited them in 10 years, and you could get additional, insight and information by doing that. Today with Reg FD and all, you really can't,
Yeah.
you don't. And there's so much available online. But I think it is true in crypto. There's still that opportunity in crypto where it's so dispersed, it's so unorganized. And I know we wanted to talk about AI tools, but Max and I are struggling finding AI tools that navigate that information very well. So that's
I know a guy.
Yeah.
I know a guy.
So yeah, I think that is still a big opportunity in crypto.
I've actually confirmed some of what you just said pretty early on too. I was like, what I do is I look for statistically significant changes in prices, and like that happens. It's actually, big moves are obviously a lot more common in crypto, but I'd be like, something's up 20%. All right, where's the news? Nothing. You go to, like, everywhere, nothing. And you like you said, X. Okay, that's like the source of truth. And then you find some crazy Twitter handle from some, I shouldn't say crazy because that's unkind, but the credibility of some of these people who are on there, and then part of it's like judging what is their influence, and if they have a ton of followers, I'm like, oh, maybe they know about this like fart coin thing, and eventually, like, I guess I just get a kick out of, you're an institutional investor and your primary source of information is Twitter. And there's nothing wrong with that, but it's just a different world we're in, and that's kind of cool that you're navigating that. And we'll work on parsing that API.
Yeah. I think. Well, one thing interested me. I don't know if you saw this, Bill, but Coinbase said they're going to partner with Perplexity as an AI partner. So we've had very good experience with Coinbase we custody at Coinbase and we trade there, and they're very good in general at everything they do. So I'm interested in that, them choosing Perplexity, but I don't know what they're doing exactly, but I'm hopeful.
And you may have just answered another question. One was, I'm new to Bitcoin. Where do I get started? And that would have been my recommendation. That's what I did after the ETF, of course.
Yeah, I think there are people with Bitcoin who need to understand Bitcoin, like how does it work? What are the details? What does mining mean and how does that work? For those people, I recommend the Bitcoin Standard. It's a great, like very granular review of all that stuff. If you read the Bitcoin Standard, you will understand how Bitcoin works. Some people care less about that and they are like, I just don't get it. Like, why does anyone need Bitcoin? Well, it's not backed by anything, it's not a thing. And I just don't understand why anyone owns it. Those people, I recommend Broken Money by Lynn Alden, who's a macroeconomist. But really, Bitcoin, to understand Bitcoin as a, like, why does anyone own it or care, is really about the history of money. And if you read her book, and when she sort of lays out the history of how technology has influenced money over time, it like makes perfect sense. Of course, you would end up with a digital currency like Bitcoin. So I think that's a great book for that.
And I suspect that this may be like a retail type that just wants Bitcoin now because they've realized that it's time. Is Coinbase the type of place where you should get your Bitcoin? Like, I noticed by accident that my Venmo account allows me to buy crypto. But where would you recommend like a newcomer go to actually make an investment if they already knew?
Well, I think you can make investments now, as you did, Bill. It talked about before in your brokerage account through ETFs. You can invest in crypto that way and not have to open any new accounts. So that's one way to do it. So there are plenty of places like that. There are people, depending on their investment style, who like Robinhood. That's a good place to go. My personal account is at Coinbase. Their commissions are high right now, but I think those will come down over time, and they have different service levels. I just have very high trust in Coinbase. I think, it's a public company. It's highly regulated. I think Brian Armstrong, the CEO, is outstanding. I think he's one of the greats of this new technological age. So I feel a lot of confidence in what he's doing, and they're part of the new stablecoin USDC circle that just went public, which was one of the most successful IPOs ever, and one of the dominant stablecoins. And they have their own blockchain, as you know, Base, and so they're sort of doing all the right things to stay in front of products and services that people are going to want. So I have a lot of confidence in Coinbase.
And have you run across people in finance usually just want to set it and forget it? The ETF or the bank. Have you run across people saying it's a bearer asset and maybe you should do a multi-sig somewhere with another bank or something else? And is that so involved that you don't even bother with?
Yeah, I think, Mark, operationally, as a former chief operating officer, one thing I learned was, complexity is to be avoided at all costs. Generally, you don't want complexity. That leads to a lot of errors or potential for exploit. So we are trying to keep it simple, but we do have more than one custody solution, and so does Coinbase. So there are multiple ways that you can custody on Coinbase, including remote cold storage, not attached to the internet, in mountains, around the world, that kind of thing.
Yeah.
So they
Well,
have
for your firm, you have to be involved in
yes.
derivatives. You have to be swapping out. But as an individual, Bill, was that an institutional or a retail question, you think, on how to hold Bitcoin?
I suspect that it was more from a retail, like they literally like just realized that they want to buy like Bitcoin, and they should read the paper and understand what they're doing. But yeah, I think there is a contingent out there that maybe they've been just following the news and developed enough understanding that they want it. So I do suspect it's a retail type of.
Yeah, I think for modest investments, again, not financial advice, but I think, investing with someone like Coinbase or others, and allowing that exchange to hold your assets without having a separate wallet or all, I think it's fine. I think as the numbers start to get bigger, then you must start to consider other
Yeah, that's a great point. Just get involved, and And then my opinion recently, because I'm actually doing this, I own the ETFs because I have retirement accounts, and I also own the coin. And, there are options whether you want to put it as collateral now, and move it around. So just get curious after you read the background, like from Saifedean's Bitcoin standard, like Jennifer said, or digital gold, which I think Bill mentioned. That's my favorite because it was 10 years ago and it tells you everything. It's like, and the guy Popper is just saying, who are these wacko cypherpunks, kind of, and he tries to treat them, and it's a distant curiosity is how he writes it, I think. And then he says, well, we'll see. So 10 years later, when Bitcoin was at whatever, $300 for or 1,000, he's like, well, we'll see. And that's why I think it's a great. But yeah, just get curious, folks. But there's a difference between the ETF and the coin may give you more optionality, but as Jennifer said, it also has more responsibility. So, put on your, responsibility hat if you want to do that.
Yeah, I think the biggest thing is to be confident about why you own it. Like, why do you own it? Because it is so volatile that it will reach prices that will cause everyone to question, wait, why do I own this thing? And so when that moment comes, you want to know why you own it.
The reason we have you on, because we've spoken to your analysts in the past, and do you find that when people come to you, they obviously want to get involved on the institutional side to allocate capital to you, but how much are you there holding hands, or guiding or informing? Because I know you write a lot. I know you folks, in order to know, you have to read and write, and then But how many? Do you find that investors are open to discussing with you, or is it still doors need to be pushed? They're not to be open for you, or are they coming in over the gunnels?
Investors do not want to talk to us. They do read what we write. Even our own clients don't need a lot of hand holding. I think the one thing that I think our clients have done well is each of them knows why they own it. So even in the depths of 2022, we got no redemptions and we got virtually no calls. Most of the calls we got were more along the lines of, what do you think of this Sam Bankman-Fried, that kind of thing, but not really about the asset class. So I think that's really a tribute to their just being long-term investors, but they don't have a lot of questions beyond, they like to sort of learn through what we write, and sometimes we'll get responses to that, like little comments or here's a piece I saw that you might be interested in. But they're as likely to send us something as they are, they're more likely to send us a piece that they saw than they are to call and ask like, hey, are you sure about this?
Got it. So it's like a collaboration. When I was at 3IQ, I did a multi-coin fund as well. And the opportunities that it was still hard to beat Bitcoin at times, but it had a different return profile. It made us smarter. And what it does is it keeps you ready, as you said, for the next cycle. It informs you. I loved those meetings that we did with the team. They were wonderful because you really saw everything. And like what you said with Max and you and your analysts all coming at it from potentially different generational and different backgrounds, you're going across that system. And it gives you, I won't say confidence, but you're a bit fortified to handle what is definitely going to be more waves of volatility.
Yep, that's right.
Mark, I think you have a train to catch.
Okay, yes, you're right.
Just coincidentally, I saw that since we've been talking, I got an email from Zapier, which, we can get in. I think we could talk forever with you, Jennifer, and unfortunately, Mark does have a train to catch. But look, this, I guess LeVar Burton is now on the AI circuit.
Oh.
And so I'm sharing this email that I just happened to get in the last 20 minutes.
This is it. This is why you got to canvas far and wide, like Jennifer said. You never know what's going to come in.
Yeah. So maybe we'll even get LeVar Burton on the new
and
Barbarians
a nod
podcast.
to the 70s with roots. I mean, folks, it all goes back to the 70s. Read the books. The Bronx is Burning, one of my best.
So yeah, with that in mind, and we're gonna wrap soon. Jennifer, where can people find you? What do they need to do to I guess, read your research or, maybe even find you for investment reasons, like feel free to plug away.
Yeah, thanks. People can find us at runadigitalassets.com. We have a little form that people can fill out for to get on our mailing list or with questions. So that anyone can get in contact with Max and me that way.
And then LinkedIn and X, do you connect with people there as well?
Yes, yes. We have a Runa Digital Assets LinkedIn, and Max and I also are both active on LinkedIn. And Max is active on Twitter. I'm more that, that meme of the guy in the attic who's looking down. That's me. I'm on Twitter just reading. I don't post anything.
No trolling? Okay, we'll make sure. Jennifer, I'm so glad that you agreed to join, and I look forward to more events. As I said, when you're in the New York area, let's try to get a dinner together with some folks, and I'll come back to you with a potential time in August.
Great.
I have an investor coming in from out of town, which would love to have you join.
Great.
And
Mark
so-
and Bill, thank you.
Yeah, and so we'll put your contact information in the show notes, and obviously, thank you. I really appreciated this. This was fun.
Thank you so much.
Great stuff. Thanks, Jennifer. See you, Bill.